Hello everybody, my name is Gary Yao, and today I would like to share with you some ideas and to answer the question is this worth to buying a house in this current market? The affordability of homes is really getting a stretch. The new challenge that we have to deal with is the fear that consumers have to deal with respect to prices going higher and higher. Which reminds me, how many times have you heard of somebody saying, I think that prices are going to come down because there will be a crash in the market? You know, I've been hearing this for the last 10 years. In the last 5 years, I have seen people sit in the sidelines waiting for the top to crash and make home affordable. While in the last 2 years, home prices have really took off. In fact, the cost of existing homes went up 19% from a year early, and supply of homes remained limited. How many opportunities have people lost because they were too afraid? When somebody says, I think home prices are too high, it all comes down to personal insecurities, fears, and doubt. It's all emotional. The forces driving home sales are the same: low mortgage and remote work. People have the ability to work from home now because it's a new economy. It all comes down to one thing: affordability. And their affordability is nowhere near what it used to be. So here's the point. If somebody was looking to buy a property, let's say worth $600,000 last year, this year it went up 20%. So therefore 20% up from $600,000, this year that property is worth $720,000. Imagine, last year you were looking to buy a house at $600,000 and you got fearful because COVID and you stopped the whole process to wait it out. Now, that house that you wanted for $650,000 is worth $750,000 to $800,000. And just the thought of being pricing out of the market is just plain painful. Most homeowners make the decision to buy their home based on emotions. And I would like to change that perspective to a more fact-based decision making. The mortgage rate forecast for the next 90 days is trending upward for June, July, August. Here's the difference between today's interest rate and what we are seeing is that we have never seen this type of interest rates before. I'm not talking about the interest rate itself or the number. I'm talking that interest rates are typically tied to supply and demand. When interest rates goes up, investors buy bonds, which provides a guaranteed yield. If interest rates goes down, then investors will buy stocks, since that money will be cheap to borrow, and then companies can borrow money to expand their operations, making the company more valuable. Do you see how this supply and demand works in the not real estate, but the bond and stock market? Now, here's the difference in today's interest rate. The Federal Reserve is buying all these bonds. One single player can alter the demand of buying all these bonds. The supply and demand component is not even on a normal operation factor. Inflation is a fear that most of us have in mind because the amount of money is being printed out. A healthy rate of inflation is 2%. Keep that in mind. Here's a segue I want to share with you. If I can prove to you that you're not going to lose money, even if you buy a property at a high inflationary year, would that allow you to make a more accurate decision that is fact-based? Let's go back to the data. You see, inflation in the 1970s was high. Let me write this down. In the 1970, home prices actually went up on average 14%, right? So if you had invested in real estate and bought at those high prices, we have lost money. In the late 80s, the home prices actually went to another 11% up. Then we have a recession in the early 90s. I'm just gonna put 90s here, right? Where the prices went anywhere from -2% to -4%, right? It crashed just a little bit. Then we have the run-up of the 2000 where home prices rose 19%. So from 2000 to 2006, home prices went up actually 19%. Great. Then the meltdown came in 2008. Now this is a very interesting year. It went down and it went down negative 37%. And in 2009, it went down 21% negative, right? But this is because of the artificial run-up on prices, because anyone with a pulse could buy a house. From 2011 to today, they have an average price of home prices increase of 8%. So 2011 till now, the average home price went up about 11%, right? Actually a little more than that, but let's be more conservative. Now, let me ask you this. If you have bought a property in a high value house at the highest in 2005, would you have lost money today? The answer? No. You wouldn't have lost any money today. I don't know why I put an down arrow, but no. Houses hold more value than just equity. If you are to buy a house, revise your options, talk to your lender, look at the whole financial situation and do your research. My name is Gary Yao, and I will talk to you soon.